Welcome everyone to Vested Interest. This is Shane back again for another portfolio update. Before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing, buying stocks in good companies that pay growing dividends and hold them for the long term. It's not rocket science in my opinion. Best way to do anything, keep it as simple as possible so it really boils down to consistently investing, dollar cost averaging, on a weekly, monthly, quarterly basis, whatever your timeline is, into dividend growth stocks and growing companies with positive cash flow that covers the dividend and have a high return on their invested capital. I cover all my investments into the portfolio on a weekly basis, really all the activity, any sells, any dividends paid out, any options that I'm in. There's nothing to pay for on this channel. I don't have a paid Patreon or another paywall that you need to go to see what I'm doing. We all have enough to pay for. So it's completely free to see what I'm doing every Sunday morning, 7:30 a.m. That's what this video is here. I did add $1,457 and some change into the portfolio. But if you are new to the channel and you would like to help out, hit that thumbs up down below, dropping a comment in the comment section, hitting the subscribe button, and turning on that notification bell. Those things all help the channel out immensely. So join us on our journey to financial freedom. Join the Vested Interest community. Drop a comment down below. Let us know if you have started your journey to financial freedom as well and what you invested in this week. Again, hit that thumbs up if you find any value in the content. Hit that subscribe button and hit that notification bell for me down below. It really does help out smaller YouTube channels. Get the word out. In my opinion, the best way to financial freedom is through investing, specifically in dividend growth investing. Let's jump into the video. So we are not doing very well in the options premium this year so far. The market has been really up and down, so it seems like whichever way I go with the options premiums that I'm playing with, they tend to either drop whenever I'm trying to go high, or they go high whenever I drop down low. So I'm going to keep plugging away. We'll keep throwing out some hooks out there and see what bites. But so far, we have not gotten any options out, and I am only running a couple plays on Bank of America, on Siboney-Stillwater, and a couple other ones right now. I may look to expand that. I have looked at a couple other. NTR is down right now, so I might look to run some options on that. MPW is another one that's down right now. I might look to run some options on that. We'll see over the next week, but even MPW, I tried to run some options on that this week throughout I think it was a $4 call, and then it dropped way down in the $2 range. So I think closed out the week right around $3. So no one was buying that one, obviously, either. So we'll keep plugging away. We'll see how it goes. But so far this year, not great on the options side. Let me know if you're doing any options and how you are doing this year. Hopefully you are having better luck than I am. Now on to the first dividends paid out on January 16th. We received dividends from Nutrien, ticker NTR. This is out of the material sector. This is also a Canadian company, so there are some tax implications around this one. If your brokerage does not take out the taxes, make sure you are setting aside some money to pay those, and make sure you talk to your tax advisor so you understand the implications as well. We received $61.67. We do have the DRIP set on, which means dividend reinvestment plan, which basically is any company in the portfolio that pays out dividends. Those funds, that $61.67 in this case, goes right back in and buys more shares of Nutrien. So it picked up 1.23429 shares of Nutrien and added an additional $2.61 over the next calendar year. And we received more dividends on January 19th. Owens Corning, ticker OC, out of the industrial sector, paid us $26.75. Again, the DRIP is set on, and my brokerage does not allow you to turn on and off the DRIP on individual positions. If yours does, let me know what brokerage you're using down below. So when I turn the DRIP on, it's for everything. When I turn the dividend reinvestment plans on, it's for all the positions in the portfolio. I can't do individual ones. Like I said, if you do have a brokerage that allows you to turn on and off the DRIP for individual positions, let me know what your brokerage is down below in the comment section. But we did receive $26.75, and those funds went right back in and picked up 0.17852 more shares of Owens Corning, which added 42 cents in additional passive income over the next calendar year. Now on January 17th, first new funds invested, we did drop $686.60 into the portfolio. With those funds, we picked up 10 more shares of Alibaba Group, ticker BABA. This is out of the consumer discretionary sector. It is also a Chinese company. So I know a lot of people may be avoiding Chinese companies because of the potential political ramifications around companies like this. This one's too cheap for me to ignore. They also recently started paying dividends, so I added it to my dividend portfolio recently. We are going to run this up to at least 100 shares, and that's what we are in the process of doing now. I think we're a little over 20 shares right now, and I don't mind. It pulled back a little bit more. I think we started buying this in the $72 range. And I'm going to keep buying it up to $80 until I get to 100 shares. Now, these 10 new shares here of BABA added $10 in additional funds over the next calendar year. And we weren't done. We went back in on Friday and added $771.30. Part of that will be our weekly buys in SCHD and VTI, and the other is Kroger. But let's start with SCHD. We added one more share of SCHD at $75.99. We added, and this is a ETF, so we did recently add a couple ETFs, SCHD and VTI. So again, we're going to build these out to 100 shares. This is part of our weekly buys. Excuse me, we're going to buy at least one share of SCHD and VTI in my portfolio every week. If you have joined this challenge and you are adding one share of an ETF, let me know what ETF that is down below. So we picked up the one share of SCHD on Friday, and we're going to do that buy every Friday. We picked up 10 more shares of Kroger, ticker KR, out of the consumer staples sector, and one more share of Vanguard Total Stock Market, ticker VTI, again, another ETF. The VTI and SCHD will be our weekly buys, at least one. There may be weeks where we add more than one if they do a nice pullback for us over the next calendar year. And these new shares, the $771.30 and the shares they picked up, added an additional $18.56. Total invested for the week, $1,457.90, and it added, along with the dividends paid out, $31.59 over the next calendar year in passive income. Now let's take a look at the sector weights here. Communications is sitting at 9.09% of the portfolio. Consumer discretionary makes up 2.76%. Consumer staples sitting at 11.89% of the portfolio. Energy makes up 6.53%. Financials sitting at 8.25%. Healthcare is the largest piece of the pie, sitting at 17.36% of the overall portfolio. Industrials sitting at 7.94%. Materials makes up, I jumped over technology. Technology makes up 7.77%. Now to materials, sitting just slightly in the lead for second place at 11.99%. Utilities at 4.68%. I am looking for one or two more utility companies to add to the portfolio. I'm just holding NextEra Energy right now. I may actually look to add a little bit to NextEra Energy, but I would like to diversify a little bit in this slice of the pie and add one or two positions. So if you have some utility companies that are in your portfolio that are doing well, or ones really that have pulled back that you really like, drop them in the comment section down below. And appreciate you, all the people out there who did share in my last video. I did cover American Electric at the end of the week, and a couple of you dropped your comments down on that one, what utility companies you are holding, so appreciate that. Next up, REITs and real estate sitting at 11.27%, and the smallest slice of the pie, ETFs, sitting at the most recent additions as well, sitting at 0.47%. And I really consider my overall portfolio my own ETF that I am building out. But I did go through Warren Buffett's and a lot of big companies' overall portfolios. Ray Dalio's another one that I like to watch. They do have ETFs in their portfolio. So even though vast majority of my portfolio is always going to and probably always will be individual stocks, I don't mind holding a couple ETFs. This gives those of you out there who don't want to invest into ETFs into individual stocks, a couple of the ETFs I would recommend and that I would hold. So that's why I'm doing that, trying to reach out to those of you who don't want to invest in individual stocks but prefer the ETFs. So these are two that I really like and would recommend if anyone was to ask. VU is another one, the S&P 500 ETF there from Vanguard. There are some, QQQ is another one, but I feel like their charges that they charge are a little high. But there are some good ones out there. So ETFs are not bad. I have ETFs primarily in my daughter's custodial accounts. And again, I'm going to add one share of SCHD and one share of VTI at least a week going forward for at least this calendar year. We'll see how it goes at the end of the year if we're going to continue to do that. Over here on the right, you can see the portfolio sector weights broken down by the percentages here, same as in the pie, but then also the dollar amount associated with each sector as well. You can see here, where is it? 20 healthcare, right there, 35,000, $37.04 in healthcare, largest position, and followed closely by consumer staples at 24 and materials at 24. So that kind of gives you the breakdown of where I'm at, and I want to try to get these evened out. I do not completely evened out. Sectors go up and down as the market fluctuates, but I don't want any one sector to be really over 20%. Healthcare is getting close at 17.36%. I don't want any one sector to be over 20% of the portfolio, and I don't want any one individual company to be over 10% of the portfolio. Now, what a lot of you come here to see on a weekly basis, again, I show this out in the open. I want you to see a real portfolio built out over the time, the ups and downs of the market and the ups and downs of a portfolio. It is going to be red at times. It is going to be green at times. It doesn't matter to me. I'm going to show you where I'm at every week, what I hold, so that you can see, like I said, a real portfolio built out over time. Here's the ticker, all the different positions in the portfolio, how many shares I own as of the close of business on Friday. The current price, also as of the close of business on Friday. Market value is just the total shares times the current price. Average share price, that's my average cost per share. What I have into each position right here. Total return, whether I'm up or down, you're going to see it in this column, right? You see the ones in the red, that means I'm down. Over here is the percent I'm up or down. Same thing. In the green means I'm up. In the red, it means I'm down. Let's take a look here real quick. Some of the positions I'm up. The highest, Williams and Sonoma. Wish I'd have bought more than 2 shares. I was actually running a wheel on Williams and Sonoma here, and I had purchased this way down in $110 at one point and kept running the wheel and was buying individual shares with the funds from that wheel. Was able to build up just a couple of shares before this one just skyrocketed, right? It's up 70.18%, but I did not get many shares of it before it really skyrocketed. I should have just held it at 110, but that is the downside to running options. If your options play, skyrockets like that and you sell it, then you're stuck with the proceeds, but not a lot of the gains. So that is one that really ran up on me. Owens and Corning, another one, I got up to 44 shares before this one really ran up. I'm up 63.51%. Ally, I was able to build out Ally quite a bit before it ran up 39.51%. HVT, 18.83%. So some of these, Union Pacific, another one I'd really like to build out Union Pacific, but it's starting to get up there now, 21.79%. So, and then you can see some of my biggest loser. MPW, biggest loser by far, 61.53%, down $5,000. I'm going to hold this one, keep reallocating the dividends back into the position, let the drip do its thing. I may add a little bit. This one dropped down in the $2 range. If it dropped down there, I might add 10, 20 shares if it drops again, but sitting at $3.07 so far. Here's the let's finish this out. Here's the sectors that each company sits in, whether they're a quarterly, monthly, semi-annual payer, their current dividend yield as of the close of business on Friday, my yield on cost. In the previous slide, we saw the sector weightings. Here's each individual position's weighting. Again, I don't want any one position to be more than 10%. The closest one I have to that right now is Johnson & Johnson. It is my largest position, sitting at 8.77% of the portfolio. This column shows the estimated annual income. This is the payout months here. Dividend growth year over year, and where it sits at 15% of its 52-week low. And I use this when I find a company that I want to add to the portfolio. I do a discounted cash flow analysis, find out kind of where I'm wanting to buy in at, and then I wait till the company is within 15% of its 52-week low, matching that discounted cash flow analysis, and then I look to get into the position. That's what this column is for. It also sets kind of a high of where I want my average share cost to be. I don't want my average share cost to be over where it sits at 15% of 52-week low. Preferably, I want it as low as possible. I need to add in, and then a couple of them you'll see. SCHD, I don't have a cost basis for, and VTI, I don't have a cost basis for. I don't care what those are. I'm going to buy one share every week regardless of where they sit. That's why I don't have a cost basis for those two. So currently I sit on 5,898.268 shares. The market value of the portfolio is $201,859.05. I just crossed over $200,000 of my own funds invested into the portfolio, $200,739.80. I am still up slightly, $1,119.25, up 0.56%. So again, if you've been following along with the channel, you can see how this changes every week. I mean, it was just a few months ago, I was down by 5, 6, 7, almost 8%. And then I was up here just last week by 4, almost 5%, now back down to only up 0.56%. So again, your portfolio is going to fluctuate up and down with the market. I don't care if the market's up, down, floating sideways. I'm going to show you what's going on in my portfolio every week so you can see what a real portfolio looks like over time and understand. Don't freak out when you see the red. I look at these red on these positions as buying opportunities. I don't mind buying SBSW with a 12% loss. It means I'm decreasing my cost basis, increasing my potential future returns, and increasing my dividend yield. So I'm not worried about the ups and downs of the market. Current yield sitting at 4.615%. My yield on cost sitting at 4.641%. And this is what I am all about. This is what I am really focused on. The estimated annual income, the dividends paid out over the next calendar year from all the positions in the portfolio continues to increase, whether the market's up, whether the market's down, whether the market's floating sideways. When I add new capital to the portfolio, when positions in the portfolio increases their dividends, and whenever positions issue dividends and those dividends buy more shares, right? So it sits at $9,316.22. And again, this continues to grow every week, every quarter, every year. And dividend growth so far on average should be at 6.7% over the next calendar year. Well, that is really it for this one. This is, as always, appreciate you stopping by. And if you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button down below. Join us on this journey to financial freedom. Join the vested interest community. We focus on dividend growth investing on this channel. Hopefully that is what you are here to see. And let me know down in the comment section what you invested in this week. How's your portfolio doing? Did you see a bit of a pullback this week? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I also do a stock pick of the day series Monday through Thursday. So if you have a company you'd like me to do a review on in that series, drop it in the comment section and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes with those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion, and if that's your journey for educational and entertainment purposes, investing involves risk. Again, lose money. You should never invest any amount. Not come to losing. Always do your own research, based on your situation and circumstances. That's like the criteria. Always seek the advice counsel. A certified financial advisor.